everyone, a very good evening. You're watching The Money Show on ET Now. I'm Obina Kapasi. This is your daily dose of 1 hour of personal finance news and opinions. Well, let's kickstart the show by telling you what we have lined up. Today, of course, is all about going to understand what exactly do the Sebi rules and the circular mean for your portfolio, your personal finances, your mutual fund portfolio more specifically, especially for those individuals who do own a multi-cap fund, because that's really where Sebi has introduced the changes. So if you already have a multi-cap fund in your portfolio, you can send in your questions and queries on the money show at etnow.tv. But not just that, we'll also tell you now what purpose or what financial goal can the multi-cap fund serve in its brand new avatar, which the Sebi has brought about. So we'll be talking about all of this and more. And joining us to talk about that, we have Kaustubh Belapurkar, the Director for Fund Research with Morningstar Investment Advisers India. Kaustubh, thanks so much for joining us today on ET Now. So like I was mentioning, the change that has been brought about up until now, the rule was that, look, you have to put 65% of your fund in equities. Now the rule is you put 75%, but that 75% has to be equally divvied up. So it'll be 25 in large cap, 25 in mid cap, 25 in small cap. So true to its name, it'll be a multi-cap fund. So let's start off by understanding first, what would it mean for, a multi-cap fund now, for the unit holders of the multi-cap fund?
Hi, Mobina, and thanks for having me on. So if you see what SEBI's tried to do, obviously we had the categorization that they launched in 2017 and, defined, this whole set of categories with mandates that they can run. The multi-cap obviously was run with the 65% equity mandate, but was left open in terms of, large, mid, and small, depending on the manager's discretion. Clearly, as you spoke about it, what SEBI's now done is set 25% each in each of these categories needs to be held by the manager. If you look at the broader category of multi-cap funds, right? A lot of them do hold a significant amount of large cap, and for various reasons, these are a lot of vintage funds that have been running sort of large cap bias portfolios for a fairly long period of time with a large set of diverse investors in them, and that's where in terms of their comfort of running an investment style or strategy was biased towards the large cap side of things. And you have a variety of sort of funds and fund managers there. But broadly, you would see the universe, there would be a large number of managers who would have a large cap bias anywhere northwards of 65% in large caps. And they've traditionally done that for many, many years now. There is a smaller subset that has been managing it with a 50, 60% large cap and the rest in mid and small. But I think the majority resides in the first category. Now, going ahead, with what SEBI's defined, funds, obviously, they're in consultation with the regulator. But basically, what the way we see things are, there are two approaches, and SEBI's also come out of the clarification late last night in terms of what they meant and what are the options for AMCs. But if you just kind of broadly outline what can happen, one is obviously that the manager wants to kind of maintain the strategy that he's been running for a while. Then the option really for them is to exit the multi-cap strategy, and they would either move the fund into a category which is closest aligned to how they've been managing the strategy in the past. But remember that SEBI also has a guideline that for most categories, you're allowed only one fund per category. So if they already have a fund in that category, which they think is the best fit, then they would eventually, need to merge the two strategies, into one single fund as per SEBI's guidelines. The other option, obviously, is for them is to actually go and meet the guidelines as per SEBI's put down, which is 25, 25, 25 in large, mid, and small. So that's a decision I think obviously managers are right now in consultation with the various stakeholders, considering what their investment mandate has been in the past and what is probably in the best interest of investors is what they're going to kind of try to get at, which is the best possible solution in the change in the amendment of the guidelines and the regulation.
Okay, so I guess you'll also have to watch out for what exactly your mutual fund house as well communicates as to what they are doing. Each mutual fund house may have a different strategy. Some may, of course, stick to the name and ensure adherence to the Sebi rule. They may have to rejig the constituents of the portfolio, which means they'll have to buy more mid and small cap stocks in the portfolio to adhere to the rule. And the others, like Kaustubh mentioned, may either change the labeling. If they already have, a fund under that label, then they will probably merge it with that label. That could be some of the possibilities. So for let's say for individuals who are going to see their multi-cap funds, Kaustubh, adhere to the Sebi norms, which means they'll have to buy more small caps into the fund, they'll have to buy more mid caps into the fund, and perhaps sell off some of the large cap stocks, because like you mentioned, a majority of the multi-cap funds do have 60 or 65% upwards in large caps. So do you think there could be some fluctuation in returns from the multi-cap fund that these unit holders can expect in the course of the next 4-5 months until Jan 2021, which is when Sebi has said that these funds have to adhere to these rules?
Sure. So, I think, Mubina, the most important thing to understand is that, and the most important thing that, when we speak to the fund managers, is try to do as little disruption as possible in terms of the investor experience of, kind of maintaining a status quo on the strategy. So, like I said, I probably expect a lot of them to reevaluate which category that fund would fall into. But if there are strategies that will potentially say, okay, look, I want to get into this category of stay in the category of multi-cap with a 25 minimum in each of these. I think from an investor's perspective, there are two things to understand and acknowledge. One is that this fund, you have to kind of evaluate, is that continuing, is it useful to be a part of your portfolio or not, given the new mandate under which it would apply? Because if you've traditionally invested in a fund that has maybe a 70-30 or a 80-20 large cap sort of holding, and depending on your risk return objectives, and you need to understand that the fund is not the portfolio itself, it is a part of the portfolio. So you need to look at it holistically in terms of what is the overall allocation of your portfolio amongst the other funds that you hold. So I think these are things that investors will need to keep in mind. But obviously, the bottom line is that if a fund that's been traditionally managed with a large cap bias does move 50% into small and mid caps, the risk profile of that fund does change. But like I said, you need to look at the intermingling of that fund in your portfolio rather than just the fund as a standalone, and then take a holistic call. That said, I think obviously the asset managers are in consultation with the regulator, and they will figure out the best course of action which they believe is in the right interest of their set of investors. So I would just wait for this space before really jumping to a conclusion, and that's the advice that I would give to investors, that do not take a hasty call. Do not try to think that if the fund's going to get into small and mid caps, potentially smaller and mid caps can run up. I wouldn't really get into that. Stick to basics. Stick to asset allocation. Wait for your asset manager to communicate in terms of the guidelines what they plan to do with the strategy. Do they stay put in multi-cap and rejig the portfolio, or do they sort of reallocate it to another category or merge, and then take a call on the parameters that I just mentioned. Obviously, you will get a load-free period of for 30 days. But also the other important thing that I would guide investors to keep in mind is the taxation impact, which can potentially come about because if there could be a short-term or a long-term capital gains depending on when you bought the fund. So I think that's another element that investors should keep in mind before making that final decision.
I think you literally read my mind over there, Kaustubh, because that was going to be my next question. That if let's say an individual is not really comfortable with this rejig that Sebi has brought about for multi-cap funds, it may be easier said than done. That okay, if you don't like it, redeem it. But then you have the taxation element as well that one must consider, which many a times we forget, because remember now, even long term, there's the long-term capital gains tax as well that one must bring into consideration. So look at your overall asset allocation and then accordingly make a decision. But more importantly, before that, wait for any communication from your asset management company, or simply put, your mutual fund house. See what they are telling you. Are they going to stick to the investment strategy, or if not, or are they going to really adhere to the Sebi norm and say that, look, we want it to be true to the name, and it does, right? It's a multi-cap fund, so they will be buying 25% of each and every category. In that case, then you must look at your portfolio holistically and see that how is it really working out for my portfolio. Kaustubh, would you agree that up until now, or actually if you could just talk to us, that up until now, what would you say is the riskometer or the risk factor of the multi-cap fund? And post Jan 2021, or let's say any new NFO in the multi-cap fund category does, is launched, do you think the risk appetite, the risk factor will change dramatically? And where would you closely most associate it to? Because we usually say, look, ETFs are, one of your most stable ones with the least amount of volatility. Then come large cap funds, and then, mid caps and small cap funds last. Where does this put multi cap funds in terms of the risk they carry for an individual?
So I think that's a great question, Mabina, and I think it's very important to understand this. One is, like I said, it has to be a portfolio context. But if I just look at it at a fund level basis, clearly, as a multi-cap fund under the new regime, what's been proposed, you will be holding at least 50% in, so 25 in mid and 25 in small cap. And obviously, managers would tend to keep a little bit of margin, given that, every 6 months, the list of stocks can be changed. So the point that I'm making is that from compared to what we've seen with a large majority of the multi-cap funds, the way they've been run with the large cap bias, obviously the risk or the volatility or the expected vols from these funds will increase because you will probably see, in the short term, greater drawdowns when there's a bear market, as we've seen the way small and mid caps can react. So I think that's important to keep in mind. What that means is that investors should be ready for slightly longer term horizons in terms of investment horizons, and also be ready for interim drawdowns, which could be larger than what they've seen in the erstwhile multi-cap avatar of that particular fund, if it chooses to remain in the in the multi-cap form. So I think these are things that investors need to keep in mind. But obviously, I mean, if I just kind of put in a pecking order, purely on an intuitive basis, it'll probably fall more volatile than large and mid caps, but less volatile than say a mid or a small cap, just given by the way that the max holding of say 50% in large cap that can potentially be held by these fund managers.
Okay. All right. Well, there you have it. So, this question, in fact, and this answer that Kaustubh's given is extremely important for every individual, because everybody has a different assessment of, how much risk that they can take on in their portfolio. You usually notice that people who are a bit younger, who are just starting off, they would perhaps have maybe a few more small or mid cap funds, or in general more equity exposure, if you have to put it that way. Whereas as you sort of advance and go closer to achieving your financial goal, whatever that may be, let's say it's retirement. As you come closer to retirement, you want something that does not have as much of volatility. It's relatively a little more stable, but mind you, equities, of course, as an asset class, does tend to have a bit of a higher, risk component. But yeah, within that bracket as well, you have all of these categories, and now maybe a little bit more of that volatility factor may be added on to multi-cap funds, especially as mutual fund houses now will have to purchase more mid-cap and small cap funds. So, Kaustubh, for whom now does the multi-cap fund essentially become suitable? It is, of course, still largely an equity mutual fund, obviously, since 75% has to go into equities at least. So, which sort of investor, in which age group, depending on what their time horizon is, would you recommend a multi-cap fund become suitable for?
I would think of it like, again, I talked about the portfolio approach. I think that's most important because the multi-cap fund cannot be your portfolio. It cannot be like, say, for instance, the single holding in your portfolio very clearly, because it's not like a one size fits all that, every investor would come with a 25-25 or a 50-25-25, there's 50 in large cap sort of allocation. It can be a part of your portfolio as long as you want to have, I would say, reasonable exposure to small and mid caps. Again, like I said, a part of your portfolio, maybe you could buy pure large caps for pure mid caps and small caps and do the same thing. And that's what a lot of investors in the erstwhile multi-cap category looked at it as, as a large cap plus sort of thing, that, it gets a reasonably sizable large cap exposure with a little bit of sort of mid cap flavor, one notch below large caps. But obviously now, like we said, the risk profile of that has changed. So I would say that you would look to get investors with some sort of, a longish time horizon. When I say longish, should be, to my mind, at least 6 to 7 years, nothing less than that. Because equities, we don't typically recommend anything less than 5 years to start with. And obviously, depending, and there's no like a ironclad definition of which age category this is necessarily suitable for. Even a 50-year-old gentleman, 50-year-old investor can have it. It's all dependent on where you think does that fit into your overall risk, profile bucket, and more importantly, investing time horizon. Because if you have an investing time horizon of just 3 to 5 years, then clearly this is not something you would recommend an investor to get into from his portfolio perspective.
Okay, Kaustubh Belapurkar, thank you so much for joining us then today on the Money Show, and sort of helping us understand that from the mutual fund industry perspective, what exactly does this mean? What should unit holders as well brace themselves for? Many thanks once again, and appreciate you giving us your time today on ET Now.
My pleasure. Thanks, Mavina.
Okay. We'll take this conversation forward and get your questions and queries as well answered on the personal finance front, on your MF portfolio bit as well. Joining us now on the show is Vishal Chandiramani, the head of products with TrustPlutus. Vishal, thank you for joining us today on ET Now. I'm sure you've got a lot of calls from your clients in the last couple of days asking you about whether they have multi-cap funds perhaps in their portfolio. What does it mean, now that, Sebi has said that, look, multi-cap funds will have to buy more mid and small cap stocks. Perhaps some of them will have to sell off or cut down on their large cap exposure as well. What's been your advice on how, individuals should read into this news that has come in from Sebi?
Hi, Mobina. How are you? Coming to the Sebi circular, I think, yes, we have been receiving a lot of calls from investors asking what they should do. I think it's important to understand the rationale behind the circular which Sebi has issued on Friday. And their objective is to ensure that multi-cap schemes are true to label, right? We've seen that prior to this circular, there was no restriction on multi-cap funds in terms of allocating between large, mid, and small cap companies. And given the volatility in the last 18 to 24 months, majority of the multi-cap schemes have had a higher tilt towards large cap funds, large cap companies. You would see that in the top 10 multi-cap funds by AUM, most of them have in excess of 70% of the AUM in large cap companies and minimal exposures to mid and small cap stocks. The idea of the regulator is that when an individual invests in a multi-cap fund, you invest keeping in mind that you will have an allocation across different market caps. That is something which wasn't happening in the current scenario, and that is the reason for this circular. While investors may be worried in terms of the impact of this, the regulator has also issued a clarification yesterday evening, mentioning that its objective is not to destabilize the markets and to have an excess rush of money going into mid and small cap stocks as was being perceived on Friday. But there are several options which mutual funds have through which they can meet this guideline. So they could either rebalance the portfolios, they could facilitate investors to switch their investments into different schemes of mutual funds. They could merge the multi-cap scheme with another existing scheme in the large and mid-cap space or the large cap space or the focused equity funds, or they could reclassify the existing multi-cap scheme into another category. Given this, I think investors should not panic and redeem from their mutual fund investments right now, and should wait for the AMCs to clarify in terms of which action they are going to take. Each AMC will decide its own course of action, and once that is decided and communicated to an investor, the investor should then act in terms of what the AMC has proposed.
So you're basically adopting for now at least a wait and watch approach. Wait for the mutual fund house to come and tell you that, look, XYZ is the action we are conducting. Let's assume that, Vishal, the individual is told that, look, we are going to stick to the label of multi-cap fund, and hence we are going to purchase some more, mid and small cap stocks, maybe trim down some of the large cap stocks, until they reach the required ratio of 25%, 25%, 25%. How would you then recommend viewers, look at their portfolio? Because I'm sure they would already be having a couple of large cap funds, perhaps, one or two mid and small cap funds as well. So how should they then read into this news and, take into consideration their portfolio as well?
Mubaina, like I said, when an investor invests in a multi-cap fund, the idea is that you get allocation across market caps. Given that now there is a minimum threshold of 25% into large caps, mid caps, and small caps, what will happen is that the volatility of the funds could increase, since they have to have a minimum 50% combined into mid and small cap stocks. So in a period of market turmoil, it could lead to higher volatility for these funds. But at the same time, if the mid and small cap portion of the funds is managed well by the fund manager, this could also lead to higher returns for investors over a longer period of time.
All right. Okay. Let's assume that, somebody who has perhaps a little lower risk appetite, maybe his or her goal is already fast approaching, or perhaps they are on the verge of retirement. What would you recommend? I mean, would it make sense then for them to perhaps either cut down their investments in a multi-cap fund, pause SIPs, maybe redeem it?
Yes, if you are close to achieving a certain goal, then you should look at moving from your multi-cap fund. In fact, if you're close to a goal, generally what we advise is that you should start moving the money into debt funds and safer investment avenues rather than keeping the money in equity funds. Even if you're keeping the money, some portion of that money into equity funds, it should be into large cap oriented funds or into hybrid funds.
I don't want viewers to hurriedly sort of take any decision as well with respect to their multi-cap funds, and hence I'll ask you this. Vishal, what are the, sort of ramifications of redeeming a multi-cap funds? Because many a times viewers tend to get trigger happy and, sort of press the redeem button or sell button. But I just want to, get this cleared and ensure that our viewers listen to this as well. What happens if you sell or redeem your multi-cap fund, especially from a tax perspective?
So what happens is there are two factors to keep in mind when you redeem, any mutual fund, whether it's a multi-cap fund or another category of funds. One is the exit load implications. So each fund has its own exit load period. If you redeem before that, you're hit with an exit load charge by the AMC. And that exit load charge is on the entire value of redemption and not just on the gains that you may have made in that fund. Apart from that, as you rightly said, there are tax implications as well. So if you redeem an equity fund in less than 1 year, you end up paying a short-term capital gains tax, which is at the rate of 15%. And if it's an investment which has completed a year, then you end up paying long-term capital gains tax, which is at a rate of 10%. So one should keep in mind both the exit load implication as well as the tax implication before taking a decision to redeem from a scheme.
Right, exactly. It's very important to understand that. Now let's understand from a return perspective. Once again, I'm just assuming that a mutual fund house will carry out these changes, because if the investment strategy is going to be kept same by, either merging this fund with an already existing fund or relabeling it, then really it's status quo. But let's assume that a multi-cap fund manager says that, okay, look, I am going to adhere to the Sebi's norms and, buy more small cap, large caps and sell large caps. Small cap, mid caps, pardon me, and sell large caps. Can I, as a multi-cap fund unit holder, expect a lot of volatility in my NAV for the next, 3-4 odd months till Jan 2021?
Yes, you would, because, and you've seen a kind of frenzy which has built up over the weekend with people expecting that mid and small cap stocks are going to run up and you will see a big sell off in large caps. So to that extent, there could be volatility in the markets. We've spoken to several AMCs over the weekend as well, and their view is that it is unlikely that you will see the kind of rebalancing from large caps to mid and small caps as some people have made out in various social media posts which were circulating over the weekend. So according to numbers which were circulating, if all the AMCs had to rebalance their multi-cap portfolios where they reduce the large cap exposure and increase the mid and small cap exposure, the rebalancing could be in the tune of 30 to 40,000 crores in the next 3 to 4 months. Like we discussed, several AMCs will take different options rather than rebalancing the portfolios completely. So to that extent, do not expect this kind of number when it comes to rebalancing. Some AMCs may decide to rebalance, but the number will be much lower than what is being circulated on social media.
Great. Well, there you have it, folks. I hope this has sort of helped you understand, as individual holders and unit holders of different kind of mutual funds, what is the implication to your overall portfolio. It's very important to understand that and not look at it as a separate unit, because your whole portfolio itself is something that you have to look at very holistically. If you're still confused, you can always ASAP email us on the Money Show at etnow.tv and we'll help you out with your questions and queries. Let's take on board our very first query. It's coming in from Anmol Sharma. He says, if they merge multi-cap funds with their respective large cap funds, if that's a possibility that will happen, and also what does that mean for unit holders? What is your reading of this, Vishal?
So if a multi-cap fund is merged with a large cap fund, you will get units of the new fund or the merged entity, which will be allotted to you by the AMC. Like we said, several multi-cap funds, especially the larger ones, already have allocations in excess of 70% to large cap stocks. So they are pretty much following the Sebi mandate of a large cap fund anyways. The Sebi mandate for a large cap fund is having a minimum exposure of 80% to large cap companies. These funds are at 70% plus right now. So, while you will get units of the merged scheme, all it will do is it will increase the size of the merged scheme for the AMC, and they'll have to manage the liquidity of a larger scheme in terms of AUM. But I don't see too much changing then for the existing unit holders.
Okay, so not much may change for existing unit holders, except that now instead of holding XYZ units of multi-cap funds, you're using XYZ units of a large cap fund. So in that sense, not much may change. Okay, we've got quite a few other questions as well lined up. Let's take those on. Upasna Ayappan writes to us saying, I stopped the Franklin Smaller Companies SIP many months ago due to underperformance, but still have funds of almost 1.3 lakh rupees, where she's still roughly losing 15% versus how much ever she must have invested. I have started SIP and other funds for the next 8 to 10 years. She's a very long-term horizon. So it's a good thing she started off with mutual funds. Now she wants to know, is it the right time to redeem the Franklin Smaller Companies Fund altogether and instead invest in a couple of other funds over the next couple of days? Okay, she's not mentioned which are the other funds, but she's particularly disappointed with the Franklin Smaller Companies Fund, which is not doing well for her. Is that something you would recommend, Vishal? Because she'll just be converting her, what we say, unrealized losses into realized losses. Is that something you'd recommend, or would you advocate holding on to them for a little longer?
So, as she has stated correctly, the Franklin Smaller Companies Fund has underperformed both the benchmark and its peers. To that extent, her decision to stop the SIP in the Franklin Smaller Companies Fund is the right decision. If she decides to redeem the investment from the scheme and allocate it to other schemes, like we have discussed some time back, she should take into account the exit load implications and the tax implications. And if the exit load period is over, as well as she has completed a 1-year time horizon, she can look at redeeming these investments and investing into some better performing schemes. What I would suggest is when you're making this change, you can, redeem and invest the entire corpus, at one time, since, you're not thereby changing your equity asset allocation. You're moving from one equity fund into some other better performing equity funds. If you, redeem and then invest over a period of time, you're actually taking a market timing decision, which is something which we do not recommend normally. Uh, since it's equity to equity, you can redeem and invest the entire money into better performing schemes at one time. Obviously, keeping in mind the exit load and the tax implications.
Okay, well, there you have it. That's the word then coming in. I hope, Upasana, you've taken note of that view. And I guess, sometimes when you stop your SIP when the markets are falling, you lose out on the opportunity to perhaps lap up more units at a lower price. So maybe viewers need to be a little wary about that. But yes, otherwise, I guess, Upasana, do take into consideration what Vishal has mentioned. Okay, I think that's all the time we have for viewer questions and queries. So we'll do one thing. We will take a very short break right here on the show. Vishal Chandiramani, thank you so much for joining us today on this episode of The Money Show, and a very important one at that. Quick break right here on the show. When we return, we will be discussing the latest update when it came to EPFO. You will be getting your interest credited to your EPFO account, not all together, but in tranches. Is the EPFO as well succumbing to the market crash that we are witnessing? We'll be taking forward that point with Jitendra Solanki. Don't go anywhere.